Hi there. In this video, we'll explain how the Residence Nil Rate Band works and how eligible UK families can maximize available inheritance tax relief.
Take a successful married couple preparing their estate. They own a family home valued at £1.5 million and hold £700,000 in unused pension funds. Under the widely publicized rules, they calculate their combined tax-free allowances and assume they are entirely shielded from inheritance tax up to £1 million. However, passing that £2 million gross estate threshold does not simply incur a standard tax. It triggers a hidden mathematical mechanism that actively reaches back and wipes out up to £350,000 of their tax-free threshold. I'm an estate planning specialist from My Tax Accountant, or MTA. Today, we are going to break down the exact mechanics of the Residence Nil Rate Band, the RNRB, for the 2026-27 tax year and show you how to secure it. The RNRB is an incredibly valuable allowance, but it is mathematically fragile. Subject to rigid beneficiary definitions, a £2 million penalty trap, and a strict freeze on threshold increases until 2031, taking a passive approach to this relief almost guarantees you will lose it. Securing the full £1 million threshold requires meeting a set of specific mathematical conditions that must be actively managed to prevent technical failure. This chart breaks down the baseline allowances for a single individual. We start with the standard nil rate band, or NRB, of £325,000. On top of that sits the residence nil rate band, providing an additional £175,000 of tax-free shelter, bringing a single person's maximum allowance to £500,000. Because spouses and civil partners can transfer their unused allowances to one another upon death, these blocks can be combined. This is how the tax system generates the theoretical £1 million maximum threshold for a married couple. But inflation is actively eroding the value of that monolith. The government has confirmed that both the standard nil rate band and the £175,000 property allowance are entirely frozen until April 2031. Rising asset values are quietly dragging more estates into taxable territory every year. To claim the £175,000 RNRB in the first place, your estate must pass a strict legal test. A qualifying residential interest, meaning a home you have lived in, must be closely inherited. Closely inherited is a rigid statutory definition. It means the property must be left specifically to lineal direct descendants. The law accepts children, grandchildren, great-grandchildren, stepchildren, adopted children, and foster children. This strict definition creates the most common point of failure. If you leave your home to a beloved niece, a sibling, or the children of an unmarried partner, the property fails the closely inherited test. Having a single incorrect beneficiary class in your will instantly invalidates up to £175,000 in tax relief, forcing a completely avoidable 40% tax charge on that portion of the estate. Even if your beneficiaries are perfectly aligned, the property allowance faces a much larger mathematical threat, the £2 million gross estate taper threshold. This line graph illustrates exactly how the taper trap works. Once an estate reaches £2 million in net value, the allowance begins to erode. For every £2 the estate exceeds that £2 million mark, the residence nil rate band is reduced by £1. Follow the math to its logical conclusion, and you find the 0 points. The entire £175,000 allowance completely vanishes for a single individual at £2.35 million. For a married couple holding a transferred allowance, the combined £350,000 disappears entirely at £2.7 million. Consider a married couple passing away with an estate valued at £2.5 million. They are £500,000 over the taper threshold. Dividing that arrearage by 2 equals £250,000. Their combined £350,000 property allowance is immediately slashed by that £250,000, leaving them with just £100,000 in relief. The most damaging technicality of this rule is how that $2 million starting point is calculated. The taper is based on the value of your estate before deducting vital tax reliefs, like business property relief or agricultural property relief. By withdrawing the tax-free allowance at the same time the estate value increases, the taper trap creates a localized, aggressively high marginal tax rate. Earning or retaining a few extra £1,000 past the $2 million mark triggers a disproportionate leap in your final tax bill. For many successful families, that $2 million threshold felt distant. Upcoming legislation is about to close that gap aggressively. Starting in April 2027, the government will bring unused pension funds directly into the estate for inheritance tax valuation purposes. Watch what happens to a seemingly safe estate of $1.8 million when a previously exempt £500,000 pension pot is poured into the calculation. The gross estate instantly swells to $2.3 million, violently breaching the $2 million ceiling and triggering the taper trap. The financial damage here compounds. Not only must the estate now pay a 40% tax on the newly included pension funds, but the sheer weight of that pension simultaneously crushes the Residence Nil Rate Band, leaving the family home exposed. The 2027 legislation turns historically tax-efficient pensions into the exact mathematical trigger mechanism that destroys the tax protection on your family home. There is, however, a sophisticated rescue mechanism available for families who have already sold their large estates, introduced in 2015 alongside the original allowance. It is called the Downsizing Addition. It is a statutory provision that allows an estate to claim the RNRB based on the value of a previously owned home, rather than the one held at the time of death. To secure it, you must prove two things. First, that you downsized or sold the main residence after 8 July 2015. Second, your estate must pass other assets of an equivalent value to your direct descendants to compensate for the lost property value. This diagram demonstrates the practical result. The legislation completely decouples the tax benefit from current property ownership. Even if you live in a modest flat, the tax relief from your former large home remains tethered to your estate like a phantom allowance. Claiming it is highly complex. The calculation requires comparing the percentage of the allowance you could have claimed at the time of the sale against the allowance available at death, generating a lost relievable amount. Doing this successfully requires absolute precision and pristine records of past property transactions. You do not need to own a valuable family home at the time of your death to claim the £175,000 relief, provided your executors know how to architect and evidence the downsizing addition. To keep the £1 million allowance intact, you must align your will with lineal descendants, monitor gross estate value against the taper, and maintain the transaction history necessary for a downsizing claim. Wills drafted just a decade ago often lack the precise legal structures required to trigger these residence-based reliefs, making them functionally obsolete under the current tax regime. With the April 2027 pension inclusion rules approaching and all basic tax thresholds solidly frozen until 2031, reviewing your estate structure is a matter of mathematical urgency. Do not leave your family's financial security to chance. Contact the specialists at My Tax Accountant today for a bespoke, forensic review of your estate to secure your allowances and prevent unnecessary wealth erosion. Please note, this video provides educational guidance based on 2020 TWIC's 27 rules and does not constitute formal independent financial or tax advice. Wealth preservation is no longer a passive exercise. Securing your family's inheritance requires active, expert navigation of a tax system mathematically designed to catch you out.